Silver didn't just move overnight. Physical tightness showed up in the places the headline price can fake, and now the market has to reconcile it. Because here's the conflict. The screen price can scream all good, plenty of supply, while the plumbing underneath quietly starts charging you a premium to get metal now, not later. And when that plumbing changes, it doesn't ask for permission. It forces behavior. It forces hedges. It forces delivery decisions. And later in this video, I'm going to give you the clean, near-term checklist. What levels matter, what confirms the tightness, what would invalidate it, and what the market is most likely to try next to shake you out. First, let's define what overnight really means in silver, because in metals, overnight isn't a vibe. Overnight is the moment urgency leaks into spreads, borrowing costs, and availability. It's when the conversation shifts from, do you want exposure, to, can you actually source it? That's a different market, and that's where the real pressure starts. You've probably seen the headline move. Silver has been ripping, pushing into the mid-80s per ounce after starting the month down around the low 70s. That kind of jump in days isn't normal. It's the kind of tape that turns calm investors into emotional traders. And that's exactly why you need to stop staring at a single price print and start watching the signals that can be smoothed over by a thin market and a hot headline. Because the next detail is what flips the whole setup. When people say supply tightens, most listeners imagine empty vaults, barren shelves, and a dramatic shortage montage. Sometimes you get that. But in modern silver, the tighter story is usually subtler and, honestly, more dangerous. The metal might still exist in large totals, while the amount that is immediately deliverable, at today's terms, shrinks fast. That's the hidden detail. Inventory isn't availability, stock isn't float, and the whole paper versus physical tension lives inside that gap. Think of it like this. A city can have plenty of apartments on paper, but if the ones that are actually for rent vanish overnight, rents spike, even though total apartments didn't change. Silver does the same thing. You can have large reported holdings in major vaulting systems and still have a scramble for the specific bars, in the specific form, at the specific location, under the specific rules right now. And when that scramble begins, you don't see it first in a headline. You see it in what the market charges for immediacy. That us ym, starting with the signal that keeps embarrassing people who only watch spot, the spread, the curve, the term structure. In a normal world, carrying a metal has costs. Financing, storage, insurance. So near-term delivery should usually be slightly cheaper than later delivery, all else equal. That's contango. It's boring. It's the market saying, we're not desperate. But when near-term delivery starts trading richer than later delivery, that's backwardation. That's not just a word. It's the market admitting, in public, that metal in hand is suddenly more valuable than a promise later. And that's not the part that matters on its own. What matters is what it forces participants to do. Because backwardation is a carry trade problem. If you're a desk that normally finances and stores metal, or you arbitrage spot versus futures, the curve is your paycheck. When the curve flips, the paycheck flips. The easy buy metal, sell forward math stops being easy. And when that happens, the market has to find a new clearing price, not just for exposure, but for delivery convenience. That's where silver gets jumpy. That's where liquidity thins. That's where squeezes start looking like mystery rallies to everyone watching from the outside. Now layer in the second plumbing signal, the cost to borrow metal, lease rates. You don't need to memorize the math, you just need to understand the message. If borrowing physical silver becomes more expensive, the market is telling you that immediately deliverable supply is in demand relative to what lenders are willing to provide. It means something wants bars now, refiners, fabricators, industrial users, bullion banks managing short exposure, or someone trying to meet a delivery obligation without paying up on the open market. It doesn't automatically mean the world is out of silver. It means the market is temporarily tight in the segment that matters for price discovery. And when that segment tightens, the screen price eventually has to catch up. Because if this one level breaks, the math changes. Here's where most people get tripped up, and it's worth slowing down for one sentence. Silver can be both well-stocked and tight at the same time. That's not a contradiction, that's structure. Major vaulting systems can report large totals, and those totals can even rise, while the truly deliverable float, metal that can be mobilized without friction, shrinks. Why? Because held doesn't mean for sale. A lot of silver is in strong hands, earmarked, pledged, allocated, or simply not offered at any reasonable premium. Some is held because it's part of a strategy. Some is held because it's part of an industrial pipeline. Some is held because moving it is costly or slow. And some is held because the owner doesn't need to be a seller. The market doesn't clear on totals. It clears on the marginal bar, and that marginal bar can disappear overnight. Now add the global layer, because silver is not a single market. It's a network of hubs. Pricing in one region can become the magnet that pulls the rest. through arbitrage, through trade flows, through fabrication demand, through simple scarcity premiums. If one hub starts paying more for immediate metal, it drags supply toward itself. That sounds obvious, but the implications are brutal. It tightens other hubs, even if nothing fundamental changed on a global balance sheet. It's just flow. It's just routing. It's just who pays up first. And that's where the real pressure starts. This is why you should care about premiums and regional signals, not just the globally quoted number. A premium is the market whispering what it can't shout on the screen. When you hear that certain products are harder to source, that delivery times are stretching, that dealers are widening buy-sell spreads, that industrial buyers are trying to lock in forward supply, those are symptoms of the same underlying thing. The tradable float is thinner than the crowd thinks. And that's not the part that matters yet. The part that matters is what happens when the market realizes it all at once. Let's talk calendar, because the why now is not optional. Markets don't choose chaos randomly. Chaos clusters around deadlines, and silver has a lot of them. Option expiries, futures roll windows, delivery notices, month end, quarter end, year-end inventory positioning, and the simple reality that liquidity is not evenly distributed across the calendar. Thin liquidity is a catalyst all by itself. It doesn't create the story, but it amplifies it. It turns a normal adjustment into a violent repricing. Right now, you have a classic early-year condition, portfolios rebalancing, risk limits resetting, and a market that just printed a huge move in a short time. When price jumps that fast, the dealer community tightens risk, market makers widen spreads, liquidity becomes selective, and that S when the tape starts feeling like a trap, because small flows can move price farther than they should. If you've ever watched silver rip $5, dump 4, then rip 6, all while the headlines repeat the same sentence, you've seen this. And the next detail is what flips the whole setup. Options, gamma, reflexivity. Even if you never trade options, options trade you, because they influence hedging flows. Here's the simplest version. When a lot of call options are bought, the dealers who sold those calls often hedge by buying the underlying as price rises. That hedging can accelerate the move. It's not manipulation. It's risk management. It's mechanical. It's math. And it becomes most powerful near certain strike clusters and as expiry approaches, especially when implied volatility is elevated and liquidity is thin. In other words, the calendar plus option structure can turn an already tight physical situation into an air pocket on the way up. It doesn't need a conspiracy. It needs positioning. Now stack the proof, because we don't do single argument stories here. One layer is the term structure. Another is borrowing costs. Another is regional premiums and delivery tightness. Another is institutional flows. And another is supply chain reality. On institutional flows, when large investment vehicles take in money, that demand has to be warehoused somehow. Even when it's paper, it can translate into real sourcing, real allocation, real custody demand. It can strain the same vaulting network the wholesale market uses for settlement and liquidity. And that matters because silver is a smaller market than people emotionally assume. It doesn't take an infinite amount of capital to stress the pipes. It takes enough capital at the wrong time, flowing in one direction, while liquidity providers are already cautious. And that's where the real pressure starts. On supply chain reality, silver is not like a product, where a higher price instantly summons new supply next week. A large chunk of silver is produced as a byproduct of other mining: copper, lead, zinc, gold. That means supply response is delayed and indirect. Even if silver's price screams higher, mines don't magically double silver output on demand, because they're not mining silver as the primary. They're mining something else, and silver comes along for the ride. Refining capacity, concentrate flows, and logistics matter. Lead times matter. Recycling helps, but it's not a switch you flip in 10 days. So in the near term, tightness is solved by one thing: price finding the level that either destroys demand, pulls in marginal supply, or forces holders to loosen their grip. And if this one level breaks, the math changes. Now, I want to address the institutional skepticism crowd directly, because you're right to be skeptical, but you don't want to be cynical. There's a difference. The market is full of incentives. It's full of positioning. It's full of players whose job is to manage risk, not to deliver you truth. That doesn't mean every move is a plot. It means the tape is often the byproduct of constraints. When a desk is short and needs to hedge, when a manufacturer needs feedstock and can't wait, when a fund needs to rebalance and liquidity is thin, the market doesn't care about your narrative. It cares about clearing, and clearing looks like violence. So what does this happened overnight? Silver supply tightens fast actually mean in practice? It means the market started paying for time. It means the premium for immediacy rose. It means the spread structure leaned toward now. It means the cost of getting your hands on metal, directly or indirectly, became less comfortable. It means participants who normally provide liquidity had a reason to step back. And in silver, when liquidity steps back, price doesn't glide. It gaps. Now, here's the trap. The very same move that confirms tightness can also set up the perfect shakeout. Silver loves to punish certainty. It will rip hard enough to pull in late buyers, then it will dump hard enough to make the thesis feel dead, then it will resume when the weak hands are gone. That doesn't mean the thesis was wrong. It means the market used volatility as a weapon. And you need a psychology shield, because without it, you'll be right about the macro and still lose the trade. And that's not the part that matters. The part that matters is how you stop being the market's liquidity. Here's the shield. First, separate trend signal from noise. Trend signal in a silver tightness story is not a single green candle. It's persistent evidence that immediacy is valued. Spreads staying firm, signs of physical demand or premiums not evaporating, and dips being bought in a way that holds key zones. Noise is the intraday whip, the headline ping pong, and the emotional contagion of watching a $4 swing on your phone. Second, respect that price can whip around violently even if the thesis is correct. That's the price of admission. If your plan assumes a straight line, you don't have a plan, you have a wish. Third, make the market prove itself at levels. Levels aren't magical lines. They're where forced behavior changes. They're where hedging flows flip. They're where stops cluster. They're where margin pressure starts to bite. And when those levels break, the math changes. So let's talk levels without fake precision. Silver has just printed new highs in the mid-80s after a fast climb from the low 70s earlier in the month. That gives you a clean map. The recent high zone, call it roughly the mid-80s, matters as the air gets thin area. If price can hold above that region on dips, it suggests the market is digesting supply tightness rather than just exhausting itself. A failed hold there, especially if it coincides with spreads easing and borrowing signals cooling, is your first warning that the overnight tightness narrative is losing urgency. Below that, the psychological $80 zone matters because round numbers aren't superstition. They're where decision-making clusters. If silver is above $80, a lot of players who were waiting feel forced to participate. If it slips below $80 and can't reclaim it, that's when it was just a spike. Narratives get louder. And that's when volatility tries to mug you. Then you have the prior breakout and consolidation zone in the mid to high 70s, roughly where the market spent time before the next vertical push. That area often acts like a retest magnet. If the thesis is real, you can see a controlled pullback into that zone, buyers step in, and the market stabilizes. If the thesis is fading, you see that zone fail, and the tape starts to feel heavy. And that's not the part that matters yet. The part that matters is what confirms which scenario we're in. Because from here, you only need two scenarios. Scenario one is the controlled pullback and retest. Price cools off, headlines shift from record to profit-taking, and the market tries to convince you the story ended. In this scenario, the important thing is not whether price dips. It will. The important thing is whether the plumbing stays tight. Do spreads stay firm relative to the sell-off? Do signs of physical premium or urgency remain? Do dips get absorbed quickly rather than cascading? If yes, that's constructive. It means the market is resetting positioning without resolving the tightness. It means the next leg can build on a healthier base. Scenario two is the continuation squeeze and gap risk. Price holds high, liquidity stays thin, and every small dip gets bought aggressively. In that world, you're dealing with reflexivity. Higher price forces, more hedging, more chasing, more stop-outs, more scrambling for metal or exposure. It can go farther than seems reasonable, faster than feels safe, but the risk is also higher. Gaps, air pockets, and violent mean reversion moves that happen when the marginal buyer disappears for a day. In this scenario, the confirmation isn't just price going up. It's price going up while the market continues to pay for immediacy, while the curve stays stressed and the symptoms done T relax. Because if this one level breaks, the math changes. Now let's confront the counterpoints, because credibility matters more than hype. The bear case you must respect is simple. In a market that just made a huge move, it doesn't take much to trigger profit-taking. Funds rebalance. Traders take gains. Volatility spikes. And that can temporarily make tightness look like it vanished. Also, when price is screaming higher, some supply does appear. Scrap flows, opportunistic selling, inventory rotation. Not because the world is suddenly flooded with silver, but because price is an incentive machine. If the tightness is mostly in the immediacy premium, it can cool quickly if the panicked demand pauses for even a week. So what would weaken or invalidate the tightness thesis near term? You're watching for a set of combined signals, not one. One, a decisive break back through key zones, especially if the market can't reclaim them quickly. Two, visible relaxation in the now premium, spreads normalizing, urgency fading. Three, a shift in behavior. Instead of dips being aggressively absorbed, you see rallies being sold and support levels cracking with speed. Four, a calming of the street symptoms, tighter dealer spreads, improved availability, less premium chatter. If those happen together, it means the overnight stress was real but transient. The market exhaled. That's normal. That's not defeat. It's information. And here's the part most people miss. Even if the tightness cools, the market may have already changed regime. Silver doesn't need to stay in extreme stress for months to matter. It just needs to teach participants that immediacy can reprice fast. Once the market learns that lesson, it stays jumpier. Liquidity providers stay cautious. Industrial buyers get more proactive. Speculators respect the upside tail risk. That changes the character of the tape, and that's where the real pressure starts. Now, let's talk about why silver specifically is prone to these episodes. It's a dual-use asset. It's a monetary metal in the minds of investors and an industrial input in the real economy. That means demand can come from fear and from factories at the same time. Add in the fact that supply response is slow and often byproduct driven, and you get a market that can run into tightness when both sides of demand show up together. Then layer macro on top. When the dollar weakens, when real yields fall, when geopolitical risk spikes, when trust in institutions gets rattled, capital looks for hard assets. That's not a slogan, it's a flow. And flows move prices when liquidity is thin. Recent reporting has highlighted exactly that kind of atmosphere. Safe haven demand, policy uncertainty, and rapid moves across precious metals. Silver has been printing record territory in that environment. That doesn't automatically prove supply tightness, but it creates the conditions where tightness becomes visible. Because when everyone wants optionality, they buy it in the same direction. And the market's job is to make that expensive. One way it does that is by stressing the plumbing. So what should you watch this week and next week specifically? Keep it simple and ruthless. First, watch the curve behavior. You don't need to be a futures wizard. Just pay attention to whether near-term tightness talk is persisting or fading. If you hear the market still paying up for immediate metal, that supports the thesis. Second, watch borrowing signals and availability chatter. Lease conditions, wholesale borrowing tone, and whether the trade starts sounding relaxed. When that relaxes, tightness is easing. When it stays tense, the market hasn't cleared. Third, watch the behavior around the $80 area and the recent highs in the mid-80s. You're not worshiping a number. You're watching whether price action is being absorbed or rejected. Absorption looks like fast dips and faster recoveries. Rejection looks like rallies that die and supports that fail. Fourth, watch volatility itself. High volatility is not automatically bearish or bullish. It's a sign that balance is fragile. It means the market can move violently in both directions. Your job is not to predict every wiggle. Your job is to avoid being emotionally liquidated. And fifth, watch the calendar. Thin liquidity windows, roll windows, and expiry-related hedging can amplify moves. If you see a sharp move into a deadline, be careful about assuming it's pure fundamentals. It can still be real. It can still be driven by tightness, but the timing can be forced. Forced moves can overshoot. Overshoots can snap back. That's how silver pays you back for getting cocky. Now here's the cleanest way to think about it without getting lost in noise. The thesis isn't silver must go up forever. The thesis is the market is pricing immediacy higher than it was, and that's a regime signal. In a regime shift, price discovery changes. Liquidity providers behave differently. Hedgers behave differently. Buyers don't wait for perfect pullbacks because the cost of waiting increases. Sellers don't rush to sell because the opportunity cost of holding rises, and the tape becomes less forgiving. That's the setup. That's the risk. That's the opportunity. And that's where the real pressure starts. So let's address what the other side will try to do, because they always do it. And it works because people are human. If silver is in a tightness-driven phase, you will see attempts to reframe it as just a speculative blow-off. You will see headlines that highlight a single-day S pullback as if it's the end. You will see confident voices telling you it's over because it dipped. And you will feel the urge to act urgently right when acting is most expensive. Your shield is a process. Your shield is a checklist. Your shield is remembering that volatility is often used to transfer position from impatient hands to patient hands. That doesn't mean you should never take profits or manage risk. It means you should decide your risk plan before the market tries to decide it for you. If you're a shorter horizon participant, your focus is levels and behavior. You want to see whether dips hold and whether the curve stays tight. If those break, you step back. No heroism. If those hold, you respect the trend, but you respect the whip. If you're a longer horizon participant, your focus is whether the market has entered a regime where physical tightness can show up quickly. If that's the case, you stop expecting smooth price action, and you stop allowing short-term noise to dictate long-term conviction. You size accordingly. You manage risk accordingly. You leave room for the market to be itself. Now, I am going to say one thing clearly because it matters. None of this is a promise of returns. This is a map of mechanisms. Silver can still drop hard even if the tightness story is real. It can drop because macro shifts, because liquidation hits, because risk-off moves force selling, because volatility spikes and people de-risk. The market can be right and still hurt you in the middle. That's why we focus on what invalidates the thesis, not just what confirms it. That's how you stay credible in a market that loves to humble everyone. So here's the near-term verdict. The overnight story isn't just that silver printed a bigger number. The overnight story is that the market has been signaling urgency beneath the headline through the premium for immediacy, through the structure of the curve, through the behavior of liquidity, and through the street symptoms that show up when real availability tightens. The hidden detail is that reported holdings and inventory can move one way, while deliverable float tightens another way. That gap is where squeezes are born. That gap is where the paper market discovers it still answers to physics, and that's where the real pressure starts. If we get the controlled pullback and retest, don't let the dip hypnotize you. Watch whether the tightness indicators cool or persist. Watch whether $80 and the mid to high 70s act like demand zones or trapdoors. If we get the continuation squeeze, respect the upside tail risk, but don't confuse momentum with safety. In a squeeze tape, the market rewards discipline and punishes ego. Gaps happen, air pockets happen, and the market will try to take your position right before it reveals the next leg. Near the end of this kind of move, the smartest thing you can do is stop being impressed by volume and start being impressed by structure. Stop being impressed by a headline and start being impressed by who is forced to act. Because silver doesn't move like this because everyone suddenly agrees. It moves like this because someone can't wait, someone can't deliver, someone can't stay short, someone can't stay underhedged, someone can't stay calm. And when that someone is big enough, the price has to adjust. If you're the kind of viewer who wants the mechanics, not the marketing, you're already in the right room. Stay with the people who track spreads, flows, inventories versus float, and the calendar pressure points, because that's how you keep your head when the tape is trying to steal it. And if you want to keep building that what to watch muscle together, stick around, not out of loyalty, but out of identity. This market doesn't reward the loudest voice. It rewards the most disciplined process. This week, watch the curve. Watch the borrowing tone. Watch the premiums. Watch behavior at $80 and near the recent highs. And watch how the market tries to emotionally manipulate you with perfectly timed volatility. Because if that one level breaks, the math changes, and if it doesn't, the pressure stays on.